Hey guys, welcome to The Market is Open. Check out our website, themarketisopen.com. Today we're going to be talking about Tesla and some of the pricing changes that Elon Musk and Tesla have done, specifically related to the Model 3. We're also going to be discussing what Tesla's Q2 earnings could look like and how that could actually impact the stock price. Something pretty interesting happens if Tesla earnings this quarter are above a certain level. So we're going to dive deeper into what that is in this video. But first, please subscribe to our YouTube channel. We would really appreciate your support in helping us grow our channel. You can also support us on Patreon, where we keep our exclusive content. So far, we've been posting information about Tesla over there, a little bit about NIO, and some Lyft. And we have plans to bolster that and talk about a whole bunch of new stocks as well. So if you want to support us on Patreon, head over to patreon.com/themarketisopen. And also check out our t-shirts, specifically our Elon Musk t-shirt, which is the integral equation that evaluates to Elon Musk. So after the tax credit got cut in June from $3,700 about to now it's at $1,700, Tesla decided to lower the price of the Model 3 by $1,000 for the base model. So the base model starts at $38,990 now. And not only that, but the default color is now pearl white, which is the multi-coat white, which used to be quite expensive. I believe it was around $1,500 to $2,000, and now that's included with the basic model of the car. So if you're in the United States, you can also get the performance model for about $55,000, and you still get what's left of the tax credit, which will completely disappear by the end of this year. The nice thing about the performance model also, I noticed, is that you get the performance wheels by default. So that saves you about $2,000. So I think we heard a couple weeks ago that Tesla has been putting pressure on BMW and of course all the other automakers. But if you hear that in your Tesla, you definitely want to put more pressure on these other automakers to really sort of stress them out. And if Tesla can pull out $1,000 or $1,500 from the cost of building a car, it can pass that on to customers, as it's doing here, by lowering the price. And you might think that's a bad thing because it could hurt Tesla's margins in the short term, but it will increase their market share if they can keep up with the production and put more Tesla cars on the road. And of course, having a larger market share and more Teslas on the road will be good for the future, especially if Tesla wants to sell apps and other features and upgrades to Tesla owners. And of course, Tesla owners are probably going to be more likely to upgrade to other Teslas in the future. However, I think that one of the best apps in the future that Tesla will have will be the full self-driving application, which will actually make money for the users of the car and for Tesla. And a lot of people might be considering now to upgrade to full self-driving in order to future-proof their cars, to get cool new features like the Summon and navigate on autopilot, auto park, and auto lane change. So I think the actual cost of building the Teslas will go down. The Model 3 specifically will go down over time as Tesla continues to boost its scale and manufacture more and more vehicles. However, the cost of full self-driving will increase, as Elon Musk says, and will increase the overall price of the car. If he eventually decides to bundle them together, then the overall price of the car will go up and it'll become an appreciating asset, which is sort of unfortunate for the people that don't own the Tesla to begin with. And the reason why the Teslas will appreciate is because this app, this feature, full self-driving, will bring in income for people who are going to be using it as part of Tesla's network and making money from it. And if the car can bring in $10,000, $15,000, $30,000, some maybe as high as $60,000, possibly unlikely. But if it could bring in, let's say, $30,000 a year, if you're just using the car on autopilot, having it drive around for you and make money, sort of like Uber, but you don't need to do anything, like while you're sleeping or while you're at work or something like that, then that adds value. That adds a huge amount of value to the car. And you actually get sort of a payback period. If you spend $50,000 on your car and it brings in $30,000 a year for the next 10 years, let's say, your car actually becomes a pretty valuable asset. And the value of it will be the present value of the future cash flows plus the salvage value at the end. And that's very different from traditional cars, which you buy, and as soon as you take them from the dealership, they start decreasing in value. And when you want to try to get rid of them, they're at bargain basement prices, and you can't really make any more money out of them other than that. However, this full self-driving feature has the potential to bring in quite a bit of cash, especially for used cars. You probably want to have your used car driving around, not your brand new $50,000 car, part of the Tesla network. So at least this is the goal for full self-driving and for Tesla, and it represents a huge amount of value for the company. Okay, so Tesla stock has fallen over the past year from about the mid $300 range to the mid 200s, and it was down in the high 170s not long ago. And this whole time, we've been hearing that Tesla is going to run out of cash and there's no demand for their vehicles. I think these are the two main reasons why Tesla stock has been crashing, along with the dismal Q1 results, of course, which led to people to believe that they were going to burn through all of their cash and that demand was in fact disappearing. However, Tesla did raise over $2.5 billion, around the $240 a share mark, which effectively doubled their cash position. So that takes the running out of cash scenario off the table, especially since Elon Musk has said that Tesla doesn't have a demand problem, meaning they will likely break even or be profitable. So cash actually should increase if that's going to be the case. And let's look at that in a moment. But so far, we know that they hit record deliveries in Q2 with over 95,000 cars being delivered. That beats their Q4 record of just over 90,000 cars. Okay, so if Tesla just hit a brand new record, then why is the stock not back at $350 or even higher if all of these negative reasons also turned out to be false? So I think the skeptical investors have moved on to the next thing. First it was cash, and then it was demand, and now they want to see some profit. So Tesla had two positive quarters at the end of last year in Q3 and Q4, but they started this calendar year off with a huge $4 per share loss. So on top of that, the tax credits have also been cut twice and will disappear in the United States by the end of this year. So some people are worried that Tesla won't be as profitable as it was in the past. And of course, they've also been playing around with their pricing. Every time they drop the price of their vehicles, investors think, oh, Tesla's not going to be making as much money. However, I think it's important to realize that market share is also extremely important for this company. But let's have a look at a few scenarios for this upcoming quarter, Q2, based on the fact that we know how many deliveries there have already been in this quarter. Okay, so I have here the past 5 quarters financial results from Tesla, and we're going to try to estimate Q2 2019. That's the quarter that's going to be reported in about a week from now. I'm going to go over 3 quick scenarios to see if we can get a sort of a low, and mid, and a high estimate for the quarter, and just see how that trickles down into the earnings per share. Okay, so I'm only going to really play around with a couple fields here because most of these accounts don't really move the needle enough for Tesla. We're going to be focusing on automotive sales, which is mainly Model S, X, and 3. And I'm going to be playing with the fields here that are highlighted in yellow. So this is automotive sales, that's revenue. Automotive sales, this is going to be the cost of that revenue. We're going to modify the SG&A, that's sales, general, and admin. And we're going to have a look at how that affects the basic and diluted net income per share. You'll also note that Tesla does have a higher share count because they issued more shares. Their shares have been going up over time, which is normal. However, as your share count goes up, that spreads your net income over more shares. So actually, a loss, if Tesla had a loss back here of the same dollar amount last year, it would only be spread over 169 million shares. And now the exact same dollar amount will be spread over 176. So that actually lowers the loss per share. However, it also lowers the profit per share. So it would be harder for Tesla to reach a higher earnings per share value even from just a couple quarters ago. Okay, so I'm going to start with 5.2 billion of automotive sales for Tesla. That translates into about 6.3 billion. I think the solar business could actually do better this quarter. I gave it 375 million for revenue because, I mean, that is a big increase from the previous quarter, but it is very nice outside. It's warm, and that's when people do tend to buy solar panels. They did have over 400 million in the past, so you would think that they would do better, especially now Elon was saying that they're going to start focusing more on that. Let's focus more on the automotive sales, which is the biggest chunk of the business. So if we look at the cost of goods sold, we're going to use the Q1 cost because this is sort of a floor. We're going to use a sort of a worst case scenario in this specific scenario, and we're going to pick the highest SG&A, which is pretty much the same number that we saw in Q3 when they actually had their best earnings per share quarter in Q3. However, they did do better in Q4, but we'll modify that in a moment. Sort of a floor for the quarter for the earnings per share. They would lose $2 per share if these were the numbers. So I think the purpose of that was just to see sort of the lowest that Tesla could go in terms of earnings. I mean, there could be one-time things that could occur during the quarter, but I think with record deliveries, investors are expecting to see at least a break even and a profit. So I actually calculated that Tesla would make closer to 58,000 based on the mix of Model 3s and Model S and X that they sold this quarter, and that is lower than the previous profitable quarters in Q4 and Q3. because Model S and X hasn't been performing as well, and those vehicles bring in way more revenue than a Model 3 being sold. Let's also switch the gross margins here to use the Q4 gross margins, because as Tesla reaches scale, they're going to be way more efficient in terms of those fixed costs, which aren't going to be allocated to a small number of cars. Instead, they'll be allocated to a much larger number of vehicles, and Tesla can be more profitable in that case. In Q4, Tesla delivered 90,000 cars. In Q1, they delivered about 63,000 vehicles. Tesla's gross margins are actually significantly larger in Q4. And lastly, let's modify the SG&A to be not the lowest, but the second lowest we've seen so far in the last year from Q1 2019, which was the last quarter. Okay, so in this scenario, Tesla actually hits about 23 cents a share. I mean, of course, this is a big estimate. However, it is above break even, and they are profitable for the quarter. So I think that's sort of a mid-range scenario for the company. Okay, now Elon Musk did make a comment, I think it was a couple weeks ago or even months, where he said that this quarter could actually be a record on all fronts. So I'm assuming that's going to be a record for revenue and for earnings in this business. Okay, so now let's do a more bullish scenario. Let's have Tesla have record revenue. So if they delivered about 90,000 cars in Q4 and they delivered about 5,000 more now, let's assume that's about at $46,000 a car. It's about 2.3 million more than in Q4. Okay, and because we're going to be a little bit more bullish here, let's assume that they get the same gross margins that they had in Q3 2018, which are slightly better than they had in Q4. And let's also give them the SG&A from the Q4 quarter, which was the best SG&A we've seen so far, which occurred at a higher scale. So that also assumes that Tesla gets 7.3 billion in total, which would be a record as well for the company. Not by much, but Elon Musk did say that it could be a record on all fronts. You would get $1.68 per share, still lower than the $1.82 they had in Q3, so we can change that in a moment. But something pretty interesting happens here, which is that if Tesla reports anything over, I believe it's about $1.47 a share, then if you add up the trailing 12 months or the last 4 quarters, you'll see that Tesla actually has a full year of profit, which will be the first time that Tesla ever has a full year of profit. And if that's the case, then Tesla will get a PE ratio for the first time. So, I mean, we can play around with these numbers. I don't think it matters too much. But I do think that getting a PE ratio is pretty important, even though the PE ratio could be gigantic, which is not that great, unless Tesla does report a huge beat, like $1 per share over the $1.47, so maybe $2.47 a share. It's possible, but I don't think that's likely, especially with the increased share count. But a big profit from Tesla would sort of eat away at this big loss over here and would give Tesla 3 out of 4 quarters of profit for the year. And I think what's even more important than profit is actually consistent profit, like not the number itself, but the fact that they're consistently profitable using the Fremont factory. And then if that's the case, then Q1 would be seen as an outlier from investors, especially since Tesla had so many problems in Q1, delivering to Europe for the first time. And investors, I think, would feel a lot better knowing that those problems are behind the company, given that Tesla is continuing to deliver in Europe and isn't suffering the same fate as it did in Q1 with such a gigantic loss. So if that's the case, then normally investors would normalize the earnings or wait for 12 months in a row of consistent positive earnings to occur. And I think if you normalize Tesla's earnings, meaning that you sort of look at Q1 as an outlier and assume that next year's Q1, that won't actually happen again and we'll actually see positive earnings. So if you do that, if investors actually can figure that out and do that, then you'll see that Tesla actually has pretty strong earnings power. Even if they make about $1 per share per quarter, so that's about $4 per year, I mean, and it's not inconceivable that the company gets 100 PE times its massive growth rate, then, I mean, that could easily make the case for a $400 stock, if not higher. And if you think that 100 times PE is quite high, then consider Netflix's price to earnings ratio, which is much higher than Tesla's, although Netflix has been growing slower than Tesla and is expected to grow slower than Tesla in the future. So I think if Tesla can just be consistent and deliver over, say, around 80,000 cars per quarter till the end of the year, especially in Q1 of next year, if they can deliver 80,000 or 90,000 plus cars in Q1, then I think you won't see such a low stock price for very long. And that'll sort of buy Tesla enough time until the China factory kicks in, which I haven't factored in at all into any of my estimates that I just talked about. But I think that the economics of the China factory are way better than Fremont. And like Sandy Munro said that the China factory will be wicked, according to him. And of course, they are selling into the largest car market in the world. So I think that'll all be incremental to the earnings. It might take a little bit of capital and some losses in order to start up in the first couple quarters, as we saw with the Fremont factory. Starting with just a few thousand cars, the fixed costs would sort of outweigh that benefit. But over time, I think the threshold. But over time, I think they can ramp up, and I think that the threshold for profit will be much lower compared to the Fremont factory. So they'll hit that sooner. Let's say Fremont, for example, is around 70,000 or 80,000 cars, and Tesla is a high-cost producer in that case. So if they sell below that amount, they generate a huge loss, which we saw in Q1. However, if they generate anything above whatever that threshold is, then they generate a huge profit like we saw in Q3 and Q4. So I'm saying that the new Gigafactory in China will have a lower threshold to cross in order to be highly profitable, and you'll see that jump sort of unexpectedly. I mean, you'll expect it because you've been watching the video and you've been following Tesla, but the analysts won't know what hit them. I was reading yesterday that Morgan Stanley, again with Morgan Stanley, thinks that the China Gigafactory will produce a bit over 30,000, I think 35 to 40,000 Model 3s in the year 2020, which is next year. So I think their estimates are a little bit low. It doesn't sound like they know how to predict Tesla's estimates, because even the Fremont factory produced more than that in the first year. Fremont produced about 40,000 Model 3s in the first full year. So if they're basing it on Fremont, which looks like they just did exactly that, copy paste, then I think Morgan Stanley will be wrong. But that's a good thing. Like, you don't need to correct them because you want to have low expectations. I think that's important for propelling the stock price higher. Also in the fifth quarter, that's like just after the first year of Model 3 production at Fremont, Tesla produced more vehicles than all of the previous quarters combined times 2. So I think that the China Gigafactory ramp will be faster because there'll be much less mistakes. I mean, the Chinese, they're working 24/7 to build this factory, and it's not Tesla's first time doing this anymore. So that's why I think that there's going to be less mistakes, and this factory is going to be built way more efficient, such as cutting one of the parts down from 70 parts down to 1. So the China Gigafactory could essentially double the size of Tesla's business in about a year. And then, of course, after that, the Model Y comes out. So this could be pretty huge for Tesla, and it's kind of strange that the stock is still down 40% from the highs, despite all of these things sort of coming together for the company. I think that normally growth companies sort of factor that into the price of the shares. Like you would say that, oh, I can never buy Tesla stock because it's always so expensive. Like that's what we saw with Amazon, for example. People have constantly said, for the last 10 years that it's been expensive, and it remains expensive and keeps getting expensive as new news comes out and as they continue to increase revenue and earnings over time. So, I mean, you could argue that Tesla is expensive because they trade at $50 billion and they make no money. But my point of going over the earnings for this video is that it's possible that they get a PE ratio for the first time. And if you normalize that over 4 quarters, you'll see that the stock could actually be quite cheap now, and things could turn around pretty quickly for the company, especially as they're putting pressure on all these other automakers in the world. All right, well, I hope you enjoyed this video. Please subscribe to our YouTube channel. We would really appreciate your support in helping us grow our channel. Don't forget to check out our t-shirts and Patreon in the description below. Smash that like button, and thank you so much for watching.